Well, hello, this is Jim Musgrave of the Research Financial Strategies. In today's market recap, I'm going to explain why it's so hard to make money in both the stock and the bond markets and how to protect yourself if we see further deterioration in the markets. Should you hold on to your investments and wait it out, or is it time to get more defensive and take risk off the table? I'm going to give you critical information that will help you weigh the pros and cons of both strategies so you can decide what's best for you. So what's causing all this uncertainty in the markets? Well, one thing is it's the election, and also there's a very good chance that the Federal Reserve is going to raise interest rates in December. But from an economic point of view, things are relatively good. So I've brought up a couple slides right here that kind of show you some of the economic indicators that we look at. One, you can see on the left side of the chart that light vehicle sales have certainly improved since the recession, and they're kind of flattening out, but they're still in decent numbers. We also see that housing starts have steadily increased, but they've kind of flattened out a little bit, but that's still not so bad. But one little thing that we see that the manufacturing and trade inventories are dropping a little bit, and also the real capital good orders are also dropping, which is also reflective in some of the consumer cyclicals that I'm going to show you in just a few minutes. So, overall, it's somewhat of a slow but somewhat of a mixed bag of economic indicators. So let's go on to a couple more slides right here. We have residential real estate is now almost to the point where it was before the recession back in 2008. We also see that the average interest rates of the mortgages are still at historical lows. Again, a 30-year mortgage is roughly 3.5%. That's as of September of this year. And the actual housing affordability index is still pretty low, historically speaking. So again, the real estate market has really, come fairly strong. There's been some talk about, are we in a real estate bubble? I'm not sure if we're there yet, but again, the real estate market is fairly strong compared to how it was a number of years ago. One thing I was going to mention that things are improving are the actual wages. You can see that the unemployment rate as of August of this year is down to 4.9%, which is a huge improvement. But one thing that's concerning people, a lot of people in this country, especially with this election, is that you can see wage growth has been very stagnant, and it's really not going much. So although the unemployment rate has dropped, the wage growth has kind of remained stagnant and isn't doing a whole lot at this point. So another thing I want to talk about is inflation. You can see that the core CPI, the blue line right here, the 50-year average is about 4%, but as of August of this year, it's only about 1.1%. And that's one reason why we've seen the Fed be reluctant to raise interest rates, and also why people receiving Social Security right now are only going to get a 0.3% increase in their cost of living adjustment in their Social Security. So again, inflation is still very low, which is a good thing. And so a couple more slides on the interest rates I want to kind of point out with. You can see again, I've pointed this out several times, that interest rates peaked in the early 80s, and we've been in a 30-year bull market. And you can see that the 10-year Treasury, the nominal yield is roughly about 1.6%, but the real 10-year Treasury yield is a negative 70 basis points. And so again, the interest rates have been very, very low, and they're going to raise gradually. But again, so it's great if you want to borrow money for a house or a car or a big ticket item. It's not good if you're looking for interest or a yield on your fixed income securities. So again, it's always a double-edged sword when it comes down to interest rates. A couple other things I want to point out. One is you can see that if you look at interest rates across the globe, the United States, although it's very, very low, is still one of the better places to be. So when you look at the UK, Japan, the Eurozone, we're actually looking at very, very low interest rates, and in fact that Japan and also the Eurozone have negative interest rates. And you can see here on the right side of my screen that government bonds with a low or negative yield, again, the percentage of government bond index with negative yields globally is about 71%. So again, the percentage of yields below 1% is 71%, and about 33% of the yields of government bonds worldwide are below zero or negative interest rates. This is not a good economic indicator. The only reason why the interest rates are low is obviously because the governments worldwide need to stimulate the economies. And again, we've been talking about this for a long time. The problem is you can't fight deflation with deflation. And so this is going to be an ongoing problem. And one of the reasons why the Fed has been reluctant to raise interest rates. So, and I wanted to kind of talk about that because, again, today the Fed mentioned that they're not going to raise interest rates in November. However, it is very likely that they'll raise interest rates in December. I think December 14th is the date that they will make the announcement. And again, what you can see is that, on the chart on the right here, is that the impact of a 1% rise or fall in interest rates can make a huge difference. So again, a 1% rise in interest rates means that the 10-year Treasury or 10-year bonds can actually drop 8.8%. The longer-term bonds can drop over 19%. So again, that's one of the challenges that we all see as investors in our fixed income portfolios, just because you remember that as interest rates rise, bond prices fall. And so, the Fed is going to do this over a period of time, a slow period of time, but, this is going to cause some volatility and losses in bond portfolios. So you just need to be aware of that, and you have to be very, very tactical within your bond portfolio in environments like this. And so, again, the sectors that have been doing well in the fixed income, obviously the longer-term corporate bonds, the high-yield bonds, emerging market bonds, as well as floating rate bonds have done fairly well and will continue to do well moving forward. So, one of the things that people have been, really searching for is yield in this low interest rate environment. So I want to kind of show you this slide. So what are some of the asset classes that we can invest in that will give you slightly higher yields than, let's say, a 10-year Treasury or a CD that you can get at the bank? Well, one of the things is that you have preferred stocks, and we've certainly owned those in our portfolio over the years. One thing is that I and many of my clients own are REITs. Either there are non-traded REITs as well as traded REITs that you can buy in a mutual fund or an ETF. But you can see that the REITs, on average, in terms of the traded REITs, are yielding roughly 3.7%. We also have convertible bonds, which are also yielding better than average. And we also have emerging markets. And even in our normal U.S. equities, in terms of large, mid, small cap stocks, we tend to look for ETFs and mutual funds that actually have a nice yield to them. And so that's the next thing I want to kind of bring up, is that in this period of stagnant growth and just things are just kind of going sideways to down, one of the things is that if you're going to take a longer term approach, then it certainly makes sense to own dividend yielding equities. Mutual funds, ETFs that actually invest in companies that have higher dividends. And you can see up here that you can look at the decades of the 2000s when the S&P was negative 24. Basically you can see that dividends were 1.8%. Again, this says that the capital appreciation was negative 2.7, but actually, if you actually run the S&P 500 between December 31st, 1999 to December 31st of 2000 or 2009, the actual S&P was down negative 24%. But you can actually see that regardless of what time period that you're looking at, the dividends can make a huge difference in a portfolio. So that's one of the things that you can certainly do is that in this environment, if you're willing to take a little market risk, then you can certainly own some dividend yielding securities that are certainly doing better than CDs at the bank. One other thing I want to kind of share with you is the flows of what's going on going into and out of different asset classes. And what's interesting is that 2016 and 2015 have been really rough years. And so you can see right here, we've actually had a net outflow of people taking money out of ETFs and mutual funds, out of equity funds. And they've been moving that money to typically, taxable bond funds, a little bit into tax-free bond funds. But you can also see there's a big increase of people putting even money in cash. And so, when you have a highly volatile stock market, a lot of uncertainty, and you have big swings in the market like we had in August 2015 and the first 2 months of this year in 2016, a lot of money goes into safer asset classes such as taxable bonds, tax-free bonds, as well as cash. And so there's right now a lot of cash sitting on the sidelines, kind of waiting to see what happens, because as I mentioned, there's a lot of risk with the election coming up, with the Fed raising interest rates, and just an overall global kind of slowdown of kind of what's going on, kind of big picture. So from here, I want to kind of show you a little bit about what's going on in the markets, and I want to take a longer-term approach. So right here, we're looking at the S&P 500 on a 5-year weekly chart. And what I want to show you right here, this yellow line is the 200-day moving average, and this is actually a 3-week moving average. And you can see, back in May of 2012, the moving average kind of touched the 200-day, bounced off those lows, and kind of came up. And pretty much from 2012 all the way up to August 2015, the market has been in a very, very strong bull market. Yeah, we've had some pullbacks here and there, and that's to be expected. But overall, we've been in a pretty strong bull market up until the last 18 months or so. So obviously, again, I've mentioned this a bunch of times that August 2015, the S&P dropped about 12% in about 4 or 5 trading days, and you can see that drop, and you can see where the blue line crosses the 200-day moving average. That was absolutely a time to sell, and you can see how the market kept on dropping and dropping until it turned around. So if you had actually sold, here in August of 2015, stayed in cash, got in below you sold right here when we had a crossover, you would have avoided all this loss. You would have made some money, and if you had sold again right here in December of last year before this huge drop again, you would have avoided all this carnage that we experienced in the first 2 months of 2016. And you can see that it's about to cross over again. Here we are in November the 2nd of 2016. So you can see that the 200-day moving average, although it's been going up, is kind of flattening out. And the 3-week moving average is certainly turning over, and it's crossed, and you can see this little red arrow. I'm not sure if you can see it, but it's certainly right there, which signals a sell signal. So if you are a tactical investor like we are, or if you are conservative and you're concerned about protecting your principal, now is certainly a time that you would want to be more defensive, possibly sell some positions, go to cash until we see what happens. So this is the overall S&P 500. If we move on to the Russell 2000, we've seen that it's been a little more choppy. Again, we've had a crossover. Again, it's only been bullish since November of 2013. Obviously, we had some problems of last fall. Although it dropped, it came back. Obviously it kind of fell out of bed last August, and then here we are in December of last year, and in January of here we are in 2016. We've had a really nice rally, but you can see that it's really lost steam over the 1, 2, 3, 4, 5, 6 last 6 weeks. The Russell has really dropped and is now crossing that 200-day moving average. So typically when things kind of go south, the small caps start turning over sooner than other asset classes. We also see right here, here's the Dow Jones Industrial Average. The Dow Jones is actually holding up fairly well, although it's pretty similar to the S&P 500. But you can see, since kind of peaked here in August 15th of this year, you can see that it's just kind of running out of steam. Same thing with the S&P. Here we are, we're under the 1800 mark, where we had already peaked above 18,500. So again, we're seeing this slow, just kind of grinding. It's like the air is being let out of the balloon. A couple other things I wanted to show you here is the NASDAQ. NASDAQ is holding up pretty well, although it's starting to turn over a little bit, but again, it's holding up fairly well. And I also want to kind of show you what's going on in the bond markets. You have TLT, which is the 20-year Treasury. Typically, Treasuries are the place to be in periods of uncertainty. And you can see right here, go back to January and February this year, we had a really nice rally in Treasuries. But with the rise of interest rates, you can kind of see that the Treasuries have kind of rolled over right here and dropped below the 200-day moving average. So that's somewhat concerning, because you go to Treasuries as a safety play, but you can see right now that they're actually going in the wrong direction. So which causes some some real issues trying to manage the the fixed income portfolio. And if we actually look at the overall bond index, so this is the AGG, which is the Core Aggregate Bond Index, which it represents many different asset classes within the bond sectors. You can see that it's done fairly well, but it's also starting to kind of lose steam as well. And so, that's one of the issues that we have, is that we have both the stock market and the bond market starting to kind of turn over, which is not a good sign. It's actually the worst of all case scenarios. Now, again, we're not in a bear market with equities, and we're not in a bear market with bonds. It's just concerning to see that we're starting to lose some momentum here. Hopefully it'll be short-lived, but you just never know. The other thing I wanted to show you was more short-term, what's going on. I'm going to go back to the S&P 500, and I'm going to kind of go to another shorter-term chart right here. So this is a one-year daily chart. And one thing I want to kind of show you here is if I'm going to bring up my Fibonacci charts, which I'm going to go there to there, and you can see that we have support. So we've broken the 2100 support level. Today we actually broke 2100. We're actually at 2097. If it continues to drop, the next support level is going to be around 2050, and if it breaks through that, the next support level is going to be around 2000, which it's been there for a long time. If I actually showed you this on a 2-year chart, you will see that, and I'll just kind of do a a price level line. Here we kind of peaked in summer of 2015, this black line right here, and you can see that here we are last August, 2 Augusts ago. We had a drop, and we never really recovered until basically July of this year, and now we're falling back over, so we're actually below where we were. Now we're actually below the all-time high, which was, again, up here just a few months ago. So again, the market has basically been extremely volatile, and basically is lower than where it was at its peak in May of 2015. So this is the frustration that we've been seeing in the market. So this is one case where, again, if you had the stomach to actually buy and hold, you're actually, a little worse off than where you were, 18 months ago. But again, it's been a very, very frustrating thing. And I also want to kind of show right here, this is the market forecast. I'm going to go back to my my year to date, and you can see this green line right here is, if it's above this 80% range, we're in a very, very strong bullish posture. But you can see that the green line right here is down around 17, which is very, very bearish. Once you get below 20, that's a very bearish sign. So, well, we experienced that previously back this past May. And again, if I go back to a 2-year chart, we had obviously the same kind of situation 2 Augusts ago, last December, in January, and so there's been several times where the intermediate line has been very, very bearish. And you can also see that reflected in the market sentiment line. So once you kind of get in this 50% range and it continues to drop, there's a very, very good chance that the market will continue to drop until obviously it turns around. So we actually we're still technically in a bull market, but we have a lot of short-term bearishness going on in the S&P. We also see a lot of bearishness, bear markets here in the Russell that I just talked about. So this is not a good sign. And if I actually go here to the three green arrow, you can see that we've had a bunch of sell signals right here, and also the stochastics is also very, very low. So this is we're experiencing a lot of short-term bearishness. Again, if you're conservative or tactical, now is certainly the time to kind of take some risk off the table. If you're more of a long-term kind of buy and hold person, you can certainly do that. And again, I go back to my 5-year weekly chart. Just be aware that we're about to cross over on our 200-day moving average, which is a very bearish sign. So if you're willing to kind of stomach these big drops like we've had in the past, then more power to you. I personally don't have the stomach for that, and so in our portfolio we've raised quite a bit of cash, and we're pretty much sticking to our core positions at this point. So one of the things I want to show you, and I'll kind of leave you with this, is that this is another chart I use that breaks down all the sectors within the S&P 500. These are the XLs. And you can see right here, this is the S&P 500. And when you see these vertical lines right here, this is the 10-day moving average, the 20, the 30, the 50, the 100, and the 200-day moving average. And so you can see that the S&P 500 is actually below its 200-day moving average. Here it is right here. And so, and you can see that the S&P 500 year to date is up roughly 2.6%, which is kind of pathetic. It's really not doing much. We've had a whole lot of volatility. As you can see, this big drop right here and these drops, and now we're kind of back to just a little bit above where we were when we started the year. But when you look at some of the other sectors that have outperformed the S&P, we have semiconductors, which is up over 26%. But you can see, semiconductors has still had a nice run, but it's certainly fallen off recently. We have energy, which is up about 12.5% year to date. It's been very, very volatile. Energy is really driven by oil. And so oil, I'm just going to bring this up as USO. You can see oil has taken a huge drop in the last week or so. And so again, oil has been very, very volatile. Obviously, it dropped significantly from last fall to February this year, and it's kind of zigzagged its way back. So oil is really kind of driving a lot of the energy play. You can see that it's been very, very volatile, and it's really dependent on supply and demand, which is dependent on geopolitical things and how much inventory is on the global market for crude oil. So again, oil is going to continue to be a factor that's going to be either a stimulus or a drag on the economy. We also see utilities. Utilities were doing great in the first part of the year, but you can see that they've lost their 200-day moving average. Again, they were a great defensive play, but utilities are not acting like they were back in the first half of the year. They've actually rolled over and showing a lot of bearish sentiment. They've actually broken their 200-day moving average, nothing but red. We also have technology, which has had a nice run up over roughly 9% per year. Now, we've had some short-term bearishness, but it's actually one of the sectors that's been kind of hanging in there fairly well. Again, we've had some short-term bearishness, but again, technology is kind of hanging in there. We also see the transportations same kind of deals. Transportations are kind of going sideways. Yeah, it's above this 10-day moving average, up 7% year to date. But again, this is not a terribly bullish, chart right here. It's just a lot of going sideways right here. XLIs are the industrials. Again, we've blown all but the 200-day moving average. You can see some short-term bearishness. XLB are materials. We've owned that this year. Again, that's fallen out of bed, not doing much. But this is what's really concerning me. I got three sectors that concern me. One is that you have consumer staples. That is the stores that middle class people like you and me go to Target and Walmart, and we buy goods and services. And you can see that there's people have not been these companies have not been doing very well. So we see certainly some short-term bearishness since summer, and that's a very bearish sign. I also want to point out the consumer discretionary. There's the more affluent people. They're not spending money. Again, that's actually down 1.38% year to date. And so the consumer discretionary stocks are really not doing very well. And another thing that's also one of the staples is healthcare. And look at how healthcare drops. So the fears with healthcare right now are due to the Obamacare, where there's a lot of huge insurance companies that are actually getting out of the exchanges because it's not profitable for them. And based on the polls, there's a reasonably good chance that Hillary Clinton will be in office. And again, she and the Democrats, especially the far left wing, are very anti-pharmaceuticals. And so the biotechs have also been taking a hit. So the healthcare had a nice run up until this August, and then it's just literally fallen out of bed. So those are three sectors that cause me concern. That you have consumer staples, we have consumer discretionary, and also healthcare are also falling out of bed. So when you look at the sectors of the S&P 500. There's not a whole lot that you can buy right now and actually make money. Okay, so this is a short-term problem. But again, I go back to the beginning of my video here. We showed that the overall, that going back to the economy, we looked to the the consumers, the sectors. Again, things have gotten much better. So we're going through a period right now of short-term bearishness that I believe is being driven by the election as well as the Federal Reserve. So if we can get through mid-December and the bottom doesn't fall out, there is a chance that we will have a end of the year rally. But again, we don't know. I mean, right now I go back to my charts and I see a lot of short-term bearishness. And again, I kind of zoom in on this stuff. Now this is I'm going to go back to my year-to-date daily chart, and you can see that with the markets kind of turn over, we certainly have some sell signals right here. So what should you do? Kind of going back, should you hold your investments and wait it out, or do you get defensive and take risk off the table? Well, again, it depends on your risk tolerance. It depends on your philosophy. In our portfolios, I've raised quite a bit of cash in our portfolios, and we're holding core positions. But we have some dry powder, so if the market continues to drop, then I won't be hurt as bad. My clients won't be hurt as bad. And if we start to have a rally after the election and after the Fed raises interest rates, then I've got some dry powder to buy and get in while prices are low, and really be end the year on a strong note. Okay, now if you are a buy and hold investor and you have some cash on hand, or you want to rebalance, my suggestion is why don't you just wait till the end of the election is over and after the Fed makes its announcement on December the 14th. At least those are the two big factors that are causing a lot of this uncertainty. And if you're taking a longer term approach, it probably makes sense to wait until that happens, okay, before you to rebalance. And again, if you're unsure about what you want to do, feel free to reach out, give me a call, send me an email. I'm happy to set up a call with you and just to kind of discuss your portfolio. If you'd like for me to review your 401k plan, just literally email me the ticker symbols in your 401k plan. I'd be happy to look them over and kind of give you some suggestions on that. So again, the rest of the year is going to be choppy. You know, the election is going to be literally 7 days a week, and we're going to have a new president. So it's going to be interesting to see what happens. One more thing before I let you run. As you probably know, I'm the president of the Baltimore, Washington chapter of the Society for Financial Awareness, or SOFA. I will be coming out with a new website in the next couple weeks, and so I'll certainly let you know about that. So I'm really excited about the new SOFA website, and I'm going to have different videos and a whole list of the workshops that we provide, you know, as a SOFA member. And if I don't talk to you between now and the New Year's, I hope you have a happy Thanksgiving and Merry Christmas. And I'll be recording another end-of-the-year video probably the first week or two in January. So again, I wish you guys the best of, you know, make the rest of the year a good one. Have a wonderful Thanksgiving and Christmas and Hanukkah. And until then, we will talk to you later. And again, if you have any questions, just give me a call, send me an email, and I'd be happy to do what I can to help you out. So until 2017, have a great year. Take care.